David, how do you read what's happened in the market, certainly this week, and I mean stretching into the end of last week, post-Fed hike, and not only what that means for oil, but what that means overall?
Yeah, that's a great question, John, and thanks for having me. Bob has it right. Energy sold off quite a lot, 17% he showed there on the charts, and that's great for inflation. And so we've been advocating, we've been moving our portfolios more defensive away from energy, reducing risk in energy, if you will, or exposure there. But most people still are going to have some energy. And the best of the best right now are the Exxon and the Chevron. You're getting a higher yield play while I think the price levels, as you showed today, are already down a little bit. I think it's a little bit oversold. And typically this is when oil and energy goes down. So yes, it helps with inflation, but that's not the whole story here. I think that we're finding a little bit of a bottom, a little bit of steady. I think it's oversold. And so for me, if you're going to have energy exposure, yes, lower than maybe the benchmarks out there in the world, but you have to have some Exxon and some Chevron. And Exxon's been doing some great moves in lower carbon. It has a better energy transition strategy. So these are very much value plays here, not growth, value plays here in energy. So I think people are going to have some exposure here. And these are two great names to reduce the overall volatility that energy is providing.
And so have we seen peak inflation? Is it coming down? You say it's still running hot, and I guess we don't need you to tell us that, but there certainly is the feeling, the sentiment in the markets that things are gonna change somehow.
Well, you see that in the numbers, you see that in the turnover, the PCE. But if you look at the 10-year break-even and the 2-year break-even, the reality is that the expectations are still way more than what they've been in the past, where they were below 2. Now they're 2.5 to 3 on those break-evens. So I think we still we've come off, and energy and commodities, as Bob said, has helped a ton. But the reality is that we're still running hot, and CPI is still above 9%, and that's a problem. And so I think that this is they're not gonna take it off. Fed speak's gonna be very active, and that's just gonna create just better awareness, more choppy trading, more awareness that you better understand what risk your portfolio have in it. Because the more you understand the risks in your portfolio,
what more can the Fed say, right? I mean, we don't have the usual time at the end of this month to actually get a hike, perhaps. So they were coming out pretty vociferously over the past few days, and the market seems to have shrugged it off. We still have some perhaps earnings revisions to go through. Is that what makes people stop fighting the Fed?
Well, I think if you look at the different recessions that we've had going back over the last several decades, revisions have been much more than they are today. So I think in order to really get where we need to be, yes, downward revisions are outpacing or outnumbering upward revisions, but clearly I think there's more to come. And so I think there's another leg down here, and I think you need to be very protective of your recent gains that you've had.
Okay. We'll watch for that head fake. David Harden from Summit Global Investments. Thank you.